All righty. Well, my name is Mike Papanchanakis. I'm with Remax Alliance. I'm the chairman of the board of directors at DMAR, and I'm excited to be a part of this panel discussion today. I think it's going to be really really exciting to hear from these people. I also represent the West District, so I'd like to start out by introducing our spotlight, industry partner spotlight, and that is Bill Remplos with Elevations Credit Union. And Bill, would you mind hopping on and just telling us a little bit about what you do at the credit union and what what you have to offer?
Yeah, sure thing. Thanks, Mike. So yeah, I work with Elevations Credit Union as a mortgage loan officer. I'm partnered with Carrie Bills to make the KB lending team within there, based out of the Denver Tech Center. And Elevations is the leading credit union mortgage lender in Colorado. So that's a nice accolade for us. And we offer all types of conventional VA, FHA, USDA programs, first-time home buyer down payment assistance. Pretty much, if it's offered, we offer it. As well as a lot of unconventional type loans, unwarrantable condos, custom portfolio loans, and unique jumbo loans. And yeah, we're just trying to keep up with this competitive landscape and doing closings in record time, a lot, 18 days or less, just to help people get under contract. So that's kind of Elevations in a nutshell.
You guys have as much of a challenge as we do in this crazy market, don't you?
Oh yeah, it's tough. We just gotta, figure out how to be better every day to compete.
Yep. I hear you. All right. Well, thank you, Bill. We appreciate you sponsoring and being a part of DMAR for sure. So I'd also like to give out a shout out to Arlen Shepard with Homespire Mortgage in Lone Tree. He helped us secure Tom Schur, one of our panelists today. So Arlen, would you like to talk a little bit about what you have to offer?
Sure. My name is Arlen Shepard. I've been in the industry now just about 20 years. I'm with Homespire Mortgage. We opened our first branch out here about a year ago. We're a very rapidly going mortgage banker. We're licensed now in 45 states across the country. One of our claims to fame is that we underwrite all of our purchases within 24 to 48 hours. So that allows us to go into the transaction knowing what our underwriting conditions are going to be, so we can close very quickly, and we're not getting down to the 11th hour in the third week or the fourth week or the second week of the transaction trying to collect conditions. But we offer virtually the whole plethora of loans from renovation. We now have a special renovation specialist working with our company who's got about 22 years in renovation, along with down payment assistance. For self-employed, we've got special bank statement loans, and for investment properties, we've got cash flow loans, so that really the borrower is qualifying more on the cash flow of the property rather than on their own asset base or their own FICO score. In any case, we're here really 24/7, just about to take care of anything that comes up. We've got a great team. We offer concierge service, so we hold the hand of the buyer all the way through the transaction to the closing table. And we pride ourselves in getting 5-star reviews. Arlen Shepard with Homespire Mortgage.
Thanks, Arlen. Appreciate your help for getting us in touch with Tom for today. This is should be a good meeting. And
it should be.
Good panel for sure. Next, I'd like to introduce our corporate sponsor, Josh Mitchell, with Senior Home Lending Advisor with Chase Bank. Josh, let us know what Chase has to offer.
Yeah, Mike, thanks for inviting me, having me on this call. Happy Friday, everyone. I hope you're all having a great morning. And like Mike said, Josh Mitchell with Chase Bank. What I wanted to me, this is probably one of the most important pieces I've ever spoke on as far as what Chase has to offer. Really exciting news that we got this week was that Chase is we lost a product when COVID hit, when COVID first started, just like a lot of lenders did. And they're reintroducing that product back this week. And what it is, I think it's more relevant than ever in this industry, in this crazy market that we're in right now. But what we're offering is a jumbo non-agency loan with 10% down, no mortgage insurance. Now, let me elaborate on that. That's going to be for a primary residence, but this is not going to be a physician loan. There's a lot of lenders out there that offer a physician loan, with 10% down, no PMI, no mortgage insurance. This is for any purchase, primary residence purchase, jumbo product, 10% down, no mortgage insurance, and the rates are extremely competitive with the 20% down as well. I think it's crucial in this market because now we are giving our buyers, if it helps them or it gives them that extra kind of leg up they need on the competition, it gives our buyers the opportunity to use possibly that extra 10% down that they were going to put as a down payment, use that towards an appraisal gap, which is what we're seeing a lot right now. So, you know, if they want to go over the listing price and they're going to need a little extra money for that appraisal gap, we'd love to be able to, you know, help out any of your current or future clients with that. You pair that with our 21-day closing guarantee, and we're also moving our clients into underwriting prior to them getting under contract, which makes it even a little bit more competitive than that 21-day closing guarantee. But you pair that up with our closing guarantee, and we're really competitive against cash buyers right now. We're still winning a lot of deals against cash buyers. And so, yeah, anyways, I just wanted to elaborate on that. I'd love to see if we can help out with any of the clients. And I certainly invite you to reach out to me. Let me know if you have any questions on this. I will put my information in the chat box so that you can let me know if you have questions on that product. I appreciate the time.
Thanks, Josh. That sounds good. Chase is a big sponsor at DMAR, and we really appreciate everything that you guys do there. So thank you very much. And all of you, go ahead and put your information in the chat box. We did have somebody put in the chat, Josh, they were asking how much the jumbo loans are. Where do they start?
So it's based on the county in Colorado. Most of your Denver surrounding counties are going to be $596, $850 or more for the loan amount. But we can definitely, if you have a specific county that you specialize in and you want to take a look at that, that information's online, but I'd be more than happy to provide that to you as well. Very
good. Thank you so much. All right. Well, now it's time to introduce our esteemed panel. And I'm going to start with our local gentleman, Scott Peterson. A lot of you already know Scott, but I'm going to read his bio for you so you get to know exactly who he is if you haven't met him before. Scott has been a real estate attorney and licensed realtor for more than 20 years. He's currently general counsel for the Colorado Association of Realtors and advises the state association on all legal matters. Scott's responsible for advising the CAR Board of Directors, Leadership Council, and CAR staff on legal matters related to the association's business. In addition, he provides legal support and education directly to CAR members and the state's local realtor associations through the CAR Legal Hotline and education events. Finally, Scott advocates for the association and realtor interests in legal matters involving third parties such as vendors, contractors, and state regulatory agencies. Welcome, Mr. Peterson. Good to see you.
Thank you, Mike.
You bet. Next is Tom Schur. He's the Chief Relationship Officer at ValueCentric. Tom started in the appraisal business in 1994 and has owned and operated a residential appraisal firm in the Chicago market since 1997. Tom has appraised over 10,000 pieces of real estate and supervises as many as 40 appraisers. Tom's focus has always been on quality, and this is evident by his loyal customers. Tom has mentored 15 licensed or associate appraisers, all of which are now certified and still active. He has always believed in teaching appraisers the right way to approach the business and the manner in which to complete a quality report. Tom is certified in both Illinois and Wisconsin. Member affiliations include Illinois Coalition of Appraisal Professionals since 1999. He is the past president of the Illinois Association of Certified Real Estate Appraisers and the Chicago Association of Realtors. He's been a part of that since 1996, and Collateral Risk Network, CRN. So, Tom, welcome. We're glad to have you here.
Thank you.
And last but certainly not least is Jess Lautz. Jessica, Vice President of Demographics and Behavioral Insights at NAR. Dr. Jessica Lautz is Vice President of Demographics and Behavioral Insights at the National Association of Realtors. The core of her research focuses on analyzing trends for both NAR members and housing consumers. Through management of surveys, focus groups, and data analysis, she presents new and innovative ways to showcase results. Jessica discusses research findings in major media outlets and international presentations. Jess received her doctorate of real estate from Nottingham Trent University in the UK. She also has a master's in public policy from American University and undergraduate degrees in political science and law and justice from the Central Washington University. Jess, welcome, and man, what an education you've had. Awesome. We're glad to have you here.
A lot of student loan debt too.
It goes with the territory, right? All right. So let's start off our discussion with you, Jess, if you don't mind. You know, the numbers are over 60% of the Denver area contracts have been selling over list price. So the obvious worry would be, is there going to be a significant number of buyers who at some point are going to be sellers and they're going to be underwater on their mortgages? What's your opinion on that?
Yeah, so I think this is a question that's top of mind for so many people right now, is just watching the bidding wars happen and people waiving contingencies and being nervous that are we in the same environment that we were when we look back at 2008 and really the home boom and then unfortunately the bust. And I will say the lending conditions are not the same. And so that's really how this environment is different, is that we see actually pretty tight lending right now. We also see a different environment because we have a lot of all cash buyers. A quarter of all offers right now are actually all cash. That's a nationwide number. I actually suspect that in your area, it might actually be higher. And the reason why I say that is because we know that Colorado has a lot of folks who are buying vacation properties, second properties there, just to enjoy the beautiful environment that you have. And we know more than half of vacation buyers are actually all cash. So I suspect that your market is actually even higher. And with that, what we do see is that those buyers really can pay those prices. We're losing a lot of first-time home buyers in that environment. And the reason why there is this stiff competition is because we don't have enough inventory. And we've been underbuilding for more than a decade, closer actually to 15 years at this point. We're starting to see some building in this environment, but people are competing for a very small amount of homes on the market, and they feel comfortable paying these prices. So I would say, no, I don't think that there's anything worrisome except for the tight competition and leaving buyers behind. I think that's where my worry is right now, is the first-time home buyers who cannot compete in this environment.
You know, my question, and I'm wondering, as we go through this and as prices continue to rise at 5 and 6% a month here in the metro area, you know, sooner or later, we've got to start running out of buyers that can't afford to buy, right? So, you know, what are your thoughts on that?
So good news, bad news. One, there's a lot of people who have a lot of money over the last year. They've been able to pop their laptop off and go home and really save and be able to cut their spending where they would have spent on restaurants and vacations and even clothing, as we all still may be in sweatpants right now. And we know that those buyers can pay a good amount of money for these homes. We also know in your state, unfortunately, there's a big influx of buyers who come from more expensive states. So I heard Nobu talking at the beginning, talking about Georgia and South Carolina and agents looking for licenses there. You guys actually do have buyers coming from Georgia, but you also have from New York, California, Texas. And those buyers can pay a good sum of money and really drive up local prices, where folks who perhaps were born and raised in Colorado are facing these higher prices too, unfortunately, with this influx of buyers coming in.
You know, that's an interesting piece of information, and you're absolutely right. I remember when I first met Nobu, because he and his family moved from Chicago, and he said, these prices are awesome. I go, oh man, you know, the locals don't think so. And I've got a lot of my clients that are moving out of state so that they can buy something, you know, a lot more house for their money, out of state and out of the metro area as well. So it's pretty interesting dynamic that we're seeing on this. Jess, another question for you. Your team in the last 6 months, they released reports on home buyers and sellers, minority homeowners, NAR members, and others. What trends are you seeing for DMAR realtors that we should be preparing for?
Oh boy. So this is a big question because some of those reports are like 200 pages long. So I will summarize it in quick panel fashion of things that I would keep an eye on if I were an agent right now. Affordability, obviously, that's top of mind for everyone. Who are the folks that we're leaving behind? Obviously, top of mind for everyone. But some big trends that we're seeing for buyers who are entering the market right now, the drop in birth rates. That's been having a lot of press lately. New York Times has been doing a lot of pieces on it. Watch that trend. It is the lowest birth rate we've had in a century. I've been beating this drum for a long period of time. It's going to impact who's buying homes. It's going to impact how much cash people have. People who don't have kids, they don't have to spend all their money, unfortunately, on sports and dance recitals and things like that. That's more buying power. It also means a change in what type of home people are looking for, the number of bedrooms, the amount of space they need, and the location. Schools are not going to be a top priority for these buyers. And this is something absolutely to watch. And just to show you the trend for what we've seen for home buyers, back in the 80s, nearly 60% of buyers had a kid in the home. That's dropped to just above 30% of buyers have a child in the home today. That is a massive, massive change in who's buying homes and what they need out of that house. The other big trend to watch is with this affordability crisis, people are getting very creative and unique in how they're purchasing homes. Multi-generational homes are up for caretaking of elderly parents, but people pooling their incomes together to be able to buy that home together. Roommates are up. That is a trend that we are seeing as well. People who used to rent together are now saying, let's purchase together. And we're also seeing unmarried couples. Now, there could be this huge marriage boom that we're seeing this summer. A lot of weddings are happening this summer as people held off last year and now they've coupled up and there's this big rush to get married and to get coupled. But we are seeing unmarried couples purchase homes at the highest rate that we've recorded.
You know, I've seen the same trend as far as multi-generational families living together. I've got a really good client of mine that is selling his house here in Colorado, and they're building a house in Florida, and he's got a 20-year-old son and a 16-year-old son, and he's got a daughter that's married with her husband, and they just had a baby. They're all going to live in one big house down in Florida. So, you know, and for the same reason, I mean, they can't, you know, they can't afford, everybody can't afford to buy a house here. The daughter and son-in-law right now can't do that. So they decided to just everybody move in together.
Yeah, it's built-in childcare and built-in, unfortunately, elder care when we think about our later ages too.
Yeah, I hope my kids are listening so that they can take care of me.
Well, that's the way it used to be, right, Mike?
Yeah, absolutely. You know, and in a lot of cultures are still doing that, right? You know, I even see it in my neighborhood because, you know, you see people walking, you know, taking their walks and stuff. And we've got a number of families in my neighborhood where, you know, mom or dad is living in the same house with the kids and the grandkids. So, yeah, there's no doubt about it. So, you know, some are saying that there's been a slight slowdown in the market, you know, like instead of 100 miles an hour now, it's only 80. So do you think that's significant, Jess? I mean, are you seeing that? And what are the data points that you're seeing that could mark a slowdown? You know, the interest rates, they're still under 3% in a lot of cases. So it doesn't seem to be a part of it. What are you guys looking at?
Yeah, so NAR does put a forecast out on interest rates, and we do look on putting that out about a quarterly basis. I will say the expectation from our chief economist, Lawrence Yoon, is that interest rates will probably go up to about 3.5. That is still incredibly low. That is still a lot of buying power for buyers today, and a great investment for vacation home buyers or for folks who do want to invest in real estate. I will say that for those buyers who are on the fringe, who are having a hard time struggling with this affordability crisis, who have watched Denver house prices go up at least 17% year over year at this point, they're going to struggle. They're going to say that 3.5 is going to price some of them out. And so we may see a retraction there. That slowdown from 100 miles per hour to 80 miles per hour, and it might actually be like 85. I don't know. It's still a very, very hot market. I would say some of that is affordability. That's going to hold back buyers. We also know that people might actually go on vacation this year. International, probably less so. So we still see this vacation buyer trend. It's still hot. We still see investors coming into this market. They might be looking at that inflationary pressure and saying, you know what, why don't I invest in real estate instead? This seems like a good place to put my money at this point. So we do see that competition is pretty hot right now.
Okay. Tom, what are you seeing in the Chicago area as far as the market and what Jess has just alluded to?
Very, very similar. And obviously, Rob Stevens, who's our manager in Denver, I checked in with him earlier this week. And the biggest thing, the difference, I mean, Chicago, same thing, right? We have high demand, low supply. The pandemic has created movement, right? It's created a lot of movement. Urban centers were pretty cool, and suburbs were hotter than hot. Many of the brokers here, we all felt, I live in the burbs, so we all felt that it was just a matter of time that the burbs were really going to catch fire, and really a lot of pent up demand, right, for suburban, because they've always been great communities, great school districts, etc. Just like Denver Metro is as well. So yeah, it's a very similar trend. The difference, though, what I've heard for Denver has been, just pure lack of inventory. Like where we say, hey, we had low inventory, but there's still, I look at the number of contracts, and what I've heard for you guys, it's been really, really tough, like the inventory, and that's exactly what that article that you posted here at the beginning of the on the chat here in the beginning. So. It's, I am seeing a cooling though. I've seen a lot of price drops. I mean, a couple $100,000 price drops. People that are just, floating it out there thinking that they were going to get a number, and, things were going under contract very, very quickly. I have seen things not flying off the shelf as quickly, and some price drops. So it seems to be some leveling, and like you said, 100 miles an hour to 80. I think that's probably a good way to put it.
Yeah, and with the price drop situation, we are seeing a couple of price drops around here once in a while. When I talk to sellers and I'm going in to talk to them about listing their home for sale, it's really a challenge to convince them that just because the market is as crazy as it is doesn't mean we can go and price it at 150,000 over what it's really worth. I mean, you can't do that. And it's really weird, isn't it? The dynamic of that. And it doesn't matter what market we're in. The dynamic of that is, as soon as you price it too high, then you got to lower the price. And then once you lower the price, man, then you're never going to even get that price, because you're not going to get offers for that much money. So
no, absolutely. And what we see, Mike, is the house that gets that max price and goes very quickly, they all share kind of something similar, right? They're very nicely done. They're move in, right? They're all done. And then you've got this seller that wants to compare physically, the outside compares, but the kitchens, the baths, the flooring, the updating, it's not the same. And in this market, right, all of us on this call know that, people want it done, and they want it done yesterday. They don't want to go through a rehab. So I think that's what we run into a lot too when we see the inconsistency.
Let me ask you something on this, Tom, because I've been doing this for the last year and a half with multiple offer situations. First of all, for my own purposes, I've been putting them on a spreadsheet, instead of looking at, 10 different, documents, 18-page documents or 30-page, whatever they are. And then I give that to the appraiser to show them what the current buyer market is saying this house is worth, even, especially when we end up selling it well over the list price. Is that something appraisers take into account to talk, even if the actual sold comparable properties aren't quite at that level? Do you take that into account when you're doing your appraisal?
Absolutely. And any appraiser should. Our job is to look at the market and the conditions of the market at the time of sale. The contract is a piece of market data. So the multiple offers, I always say putting them in a spreadsheet's perfect. That's exactly what I personally and my team likes to see. If you know, whatever you're comfortable with, and I'll share with you guys this ultimate appraisal package that I've built over many years, getting feedback from realtors. It's a checklist to prepare and how to best prepare for the appraiser, and we'll make sure and get this out to you guys. But in there talks about sharing those multiple offers. I like for you guys to make friends with the appraisers. So I think a good way to make friends with appraisers is to save them time. A floor plan from an old appraisal and a plot of survey is a fantastic way to make a friend with an appraiser, right? Put those as 1 and 2 in your, what I call the appraisal package. All the other neighborhood information and things that I like for all of you to put in there, and then email that to the appraiser prior to the appointment. Don't hand them a big stack of paper when they get to the house, right? Having a nice, prepared, professionally put together document emailed, looking forward to meeting you tomorrow at 10 a.m. I've prepared a nice, package here for you. I think it engages and it cools the temperature sometimes with appraisers and realtors. It shouldn't be that way. It isn't with our firm, but I think sometimes it can be that way. But we surely appreciate it. I'll tell you what, in the last economic downturn, what I realized, Mike, exactly to your point of the multiple offers, you cannot go back and prove the conditions at the time of sale, right? You can't go back and run data to say, hey, at that point in time, this market had very low supply, high demand. You can't go back and do that. So you have to do that at time of sale. And that data that you gave us or give us helps us do that. And what I call coming in at the upper end of the range of value, right? If you have a range of value and you have all those things we just talked about, you should be coming in at the very upper end of the range of value when you appraise in a market like we're in right now.
Well, and you know what, that packet that you're going to share with us is awesome. We appreciate you doing that. And Julie mentioned in the chat that she's going to put it in the DMAR website. So make sure you guys all go in there and take a look at that. So that's great. So what, Tom, there's reports that we have listing agents that they're changing the prices of their listings in the MLS to reflect the contract price, which is, I don't understand that. It's absolutely the wrong way to deal with it for the appraiser, don't you think? I mean, what are some of the things, the other tips that the better, you mentioned meeting the appraiser, preparing a nice packet for him. I think that's awesome. A lot of agents don't even realize you can go and meet the appraiser. They would like to meet you, and they do appreciate you handing them a packet of information. It's not, you're not trying to influence them in the wrong way or anything like that. You're just doing something that's going to make their job a little bit easier. But have you seen that? Have you seen anybody changing the price in the MLS to match the contract?
Yeah, we were just talking about this yesterday with my team, because the data center here in Chicago supports, the Denver market, Arizona. The only place that they've seen it was in Phoenix, that they've seen that happen. Other than that, all the other markets that they're reviewing in and getting involved in, they have not. But yeah, it's not the way to go. You want to use data. Anybody that's in real estate, if you are not comfortable running data, get comfortable with it, right? And take some classes. They're all offered through all the different boards and what have you. Every office has what I call a data scientist in that office. There's always one in the office. Grab that person and have them help you building the data. And all of the buyers are educated, smart people, right? They love the charts, the graphs, the data. So I highly recommend using that to your advantage when you're putting this together. And really, I can't say this enough, when you are in a moving market like we're in right now, pending sales are your best friend. Pending sales are the market, and all the pendings move together. Okay, so you guys are cyclical like we are in Chicago. I call it the winter slumber. You guys get to ski though. You know, we just sit on our couch and wait for it to warm up. So I love to.
That's why everybody's moving here from Chicago.
Yeah, absolutely. So, but you know, the seasonality is a big thing. And so every spring market, it's all about the pendings. And this is very similar to what we're dealing with now. Pending sales, track them closely, work with your loan professionals. When you've got something under contract, right? It might not be wise to try to push a closing so quickly, right? Because you need support for the appraisal and you've got other comparable properties that are going to be closing and those all move together. So there's ways that you should be looking at it, taking a holistic approach to that. And sometimes, look, it's got to close quickly and you can't interfere, and I get all that. But just look at, just really track the pendings and, you know, what's an active listing right now? We're on this call, 40 properties just went under contract, right? So, yeah, you know, really track the pendings very closely. When are they closing? And, you know, sometimes you can't get the exact contract price, but try to get that. Remember, Fannie Mae and Freddie Mac have the most robust database on the planet, way better than any MLS system. Why is it better? Because they have every pending sale, the measured square footage from the appraiser, all of the interior photographs, concessions, and the exact contract price. They have all of that. And the lender, just like Jessica mentioned, there's not, you know, there's many guardrails in place now, not like the last time. And the lenders have collateral underwriter, where all of this data goes up into the system, and they can score the appraisals and they can look at all these things. So you've got to really track those, and that really is the way to get to what I call real-time valuation, right? Not closed sale. A closed sale now is almost too far behind the market, right?
Yeah.
So we've got to really, really look at real time, and that's how we do it. And in my opinion, that is the best way to bridge that gap, rather than having to, you know, play around with list prices and things like that.
You know, and I'm glad you brought that up, Tom. I've found recently that other brokers that have pending sales in the area of you know, if you're listing or where you're looking to list a property for a seller, are more than willing to give you information. You know, I've called other brokers that had last week. I was doing a listing presentation for a seller, and there were 3 pendings that were right in the neighborhood, very similar properties as far as size and condition and age. And I called those brokers and that had pending contracts, and they opened right up to me. And as a matter of fact, one of them even said, "I'm going to send you a list of the buyers that made offers on this house that didn't get it, so that when you get yours listed, you know, you can call those agents and say, hey, you know, this one's coming soon if your buyers are interested or they haven't found anything." So, you know, people are, the good brokers in the metro area here are cooperating with other brokers in a lot of different ways, because we all know that we need that information in order for everybody to do the job better for their clients. And that's really what it comes down to. So,
absolutely.
Yeah. So Scott, you've been sitting there so quiet, and you know, we love hearing from you because you always have some great insights. So, you know, you're seeing this too, right? You're on the hotline and you're talking to brokers about all these crazy things going on. You're seeing buyer agents advise contract terms like waiving inspections and uncapped appraisal gaps. You know, they don't even have a cap on them. Those don't even make any sense. There could be significant blowback on these clients after the transaction. What are you hearing, and how do you advise we keep our buyers competitive and yet, you know, keep them safe at the same time?
Yeah, well, thank you, Mike. And I was quiet because I think a lot of people on this listening in are probably tired of hearing it from me at this point. You know, I've been loud and active for a lot of the people on here for a while, but and so thanks to DMAR for inviting me to join. And I just want to acknowledge these Connect events that DMAR is putting on, I think, are phenomenal. I've been watched a handful of them, and so kudos to Nobu and Julie and Hannah and DMAR staff for putting together these really fantastic and high quality events on a monthly basis. So to answer your question, Mike, yeah, I mean, all of this market velocity creates, from the risk management side, a whole bunch of concern. And I think, you know, the crazy things that buyers are willing to do in this market to compete, and that buyers have to do, frankly, in many cases in this market to compete, create a ton of risk for buyers agents. And there's also a ton of risk on the listing side. So, you know, I've spoken a lot about the appraisal gap clauses and how much I don't like them, and the concerns that I have about both the short-term implications as well as the long-term implications. And so just very quickly, the short-term implications on for not just appraisal gap clauses, but a lot of the contingency waivers and escalation clauses and other stuff that we're seeing. The short-term implications are this: I am getting a ton of inquiries from listing brokers who are telling me, you know, hey, we went under contract. We had, you know, 15 different offers. My seller selected this buyer on the basis of, you know, these contingency waivers or this escalation clause or this appraisal gap coverage. And now they're terminating, you know, based on some other issue, right? Or the appraisal comes back and then they're terminating based on loan or whatever it is. And so these allegations related to what I'll call bad faith termination are creating a ton of earnest money disputes. The listing broker calls and says, listen, my sellers don't want to sign an earnest money release because they believe the buyer entered this contract in bad faith. They induced my seller to sign the contract, accept their offer based on terms that they weren't willing to perform, and clearly, you know, terminated a contract based on that fact. And so the short-term implications to all of this nutty behavior is already manifesting itself in the earnest money disputes that I'm seeing for buyers who actually aren't performing. So I think it's super important if you're a buyer's agent to make sure that your buyers understand that a lot of these contractual commitments that they're making, they're not. It's not a, well, we'll see if I can bring up to an additional $15,000 or $20,000, or, you know, oh, if it doesn't appraise, then I'll see if I can tap into my parents or my rich uncle, or, you know, come up with the money in some way. These are firm commitments that they're making at the time of contract. And frankly, my advice to listing brokers who are calling is, to the extent that there's some understanding or acknowledgement that there was bad faith, then your sellers probably shouldn't sign an earnest money release, because they're probably entitled to it if they can demonstrate elements of that bad faith. So that's the short-term implications. Long-term implications, I think your question for Jess a little bit earlier sort of alluded to. Buyers need to understand that, and I'm hearing crazy numbers. I think the largest appraisal gap guarantee or coverage that I've heard is $225,000, but I've heard an awful lot of them in the, you know, $30,000, $40,000, $50,000, $100,000 range. And the buyers who are contracting and closing essentially upside down on their properties, you know, the market's not always going to do this. And if it does, then clearly, you know, $100,000 appraisal gap is maybe not that big of a deal, because in 2 or 3 years, theoretically, the appreciation will have continued at this pace, and they'll all be fine. But as anybody who's sitting in on this call today understands, we are not in any kind of conventional real estate market at all with regard to the price inflation, and that simply can't sustain. And so very easily, looking out 2, 3, 4 years, we will be, I believe, in a much flatter market. And we may even, depending on what other factors, you know, we're hit with as a country, we may be in a declining market again. And God forbid that happens to one of your buyers who goes under contract and is upside down to the tune of maybe 6 figures from closing. If the market's flat or goes down, they're going to be pointing fingers at their buyer's agent, saying, you know, how could you have let me, you know, do this 2, 3, 4 years ago? Yeah. So make sure you guys are being good about memorializing your cautionary professional standard of care anecdotes for your buyers as you're writing some of these contracts, and waiving clauses or creating clauses that are appraisal gap or escalation clauses, et cetera. The last thing I'll point out that I'm seeing a ton of is that buyers who are closing well above the value of the home and doing crazy things to get the house closed, now are expecting the condition of the property to be perfect when they move in. So I'm also seeing now an explosion in post-closing disclosure inquiries. In other words, buyers who now move in and, they realize they're upside down on the home that they bought, and now that they've moved in, they notice all the creaks and cracks and all those little issues. And so what I'm seeing is a lot of buyers agents, 2, 3, 4 weeks after closing, 2, 3, 4 months after closing, reaching out and saying, hey, my buyers are furious about this. And, in a normal market where they're paying, reasonable dollars for a home, they're more willing to forgive a failure to disclose some of those things on behalf of the seller, or not. It doesn't annoy them so much. Now that they're, way overpaying and reaching for these properties, they're expecting things to be really perfect. So listing brokers need to make sure your sellers understand the importance of, robust disclosures so that they don't end up on the receiving end of a post-closing lawsuit for failure to disclose.
Yeah, good, really good point. And a couple things that you said there, I wanted to comment on. And actually, I'm involved in a situation right now with an earnest money. We just had a termination yesterday on one of my listings. The buyer was using a lender that is absolutely one of the best lenders that I've ever dealt with. So when I spoke to the lender about the buyer's ability to perform and to get the loan, when we first were looking at the offer, the lender told me they absolutely was going to be no problem whatsoever. They couldn't foresee anything as an issue. And lo and behold, the broker called me crying, saying my buyer's going to have to terminate because she can't get her loan. And I thought that doesn't even make any sense, right? So I called the lender, and of course the lender has a confidentiality commitment as well. But reading between the lines, it sounds like this buyer was not willing to supply the lender with any documents. So, I recommended to the seller to not allow the earnest money to go back to that buyer. They just didn't perform in good faith. I mean, it just doesn't even make any sense to me. They worked so hard to get this deal, and then they don't want to supply any documents to the lender for their loan. So it's absolutely crazy. And your mantra of do right by your clients is something that everybody needs to be thinking about. You mentioned that these buyers are getting into these things, they don't even realize what they're doing, and I think that's true. I think we as realtors need to really go the extra mile to make sure we explain the consequences of some of these actions. And then same with the sellers. When they get excited about no inspection objection or no inspection termination, the buyer's waiving that is a huge risk for that seller. And one of the things that I've been recommending to sellers is before you put it on the market, let's do an inspection. Let's do an inspection so that, because there's a lot of stuff you don't even know about your house. But if we do an inspection and we have it ready and we have a buyer that doesn't want to do it, we can disclose and just give them a copy of that inspection report. That'll protect you down the road. So the sellers have to be just about as vigilant as the buyers and be careful so that they don't get these lawsuits a year or 2 years down the road. So any other advice you can give these buyer agents, Scott?
Well, yeah, I mean, it comes back. Well, just to close on your point about the inspections. Yeah, I've been sort of blown away by the fact that sellers are so willing to allow a buyer to waive inspection, because if the buyer's not inspecting the property in a formal or contractual sense, then really the 100% of the entire lens on that property comes through the seller's property disclosure. And so I believe that activity is going to lead to a ton of post-closing failure to disclose lawsuits against sellers, just because the buyer can legitimately say, hey, you didn't disclose this or that. And even the stuff that would normally we would describe as like a patent defect or something that was open and obvious and any idiot with two eyes could see. If you're not doing an inspection, then it's a little bit more difficult to justify or for a judge, in some lawsuit after closing, to justify it's a little easier for a judge to justify a buyer not seeing something that, is open and obvious and, quote unquote patent. And so I definitely don't like inspection waivers, both for buyers for the obvious reasons, but I also don't like them for sellers. And then just for buyer's agents, I guess, I can't state enough that the 90-second email that you send to your client as you've gone back to your computer to write the offer and waive contingencies at the buyer's instruction or write an appraisal gap clause at the buyer's instruction is that 90-second email that you send doesn't have to be legal, doesn't have to be formal, doesn't have to be intimidating. Just say, hey, I just want to confirm we talked about the implications of, waiving your loan conditions when you need a loan or waiving the appraisal. We had that conversation. Just want to confirm that you're comfortable with that. That is a bar of gold in your transaction file at some later point in time, to the extent that somebody comes back and says, hey, you didn't meet your standard of care. So just take the extra minute or two in this really volatile market to memorialize that stuff. And if we have time later, I'll give you a quick story, a jaw dropper on the listing broker side, but I'll let you move on to some of the other panelists here if you'd like to.
Thanks, Scott. Yep, we'd love to hear about that. So I'm going to go back to Jess real quick, if I could. Now that we're coming out of this pandemic, and I don't, I'm not sure what you guys are seeing in other parts of the country, but in Colorado, we're pretty well opened up. I mean, things are pretty well opened up. What kind of real estate business trends are you seeing that you think are going to stick? And which ones are going to go away?
Yeah, that's a really good question. I think every area of the country right now is, it's at some aspect of opening up. The pandemic obviously has changed so much buyer behavior. We've talked a lot about that transition to the suburbs and the need for more space. As far as business activity goes, I think it has to be virtual. Virtual has always been here. Members have always used tech tools that are out there and really embraced them. But the pandemic forced everyone to really be using these tech tools in different ways, be more strategic about the homes that you're seeing in person. And a lot of that has to do with the lack of inventory as well. If there's not 12 homes in your price point that you can actually see, you're only going to see the few that you can, and you're going to see them as quickly as possible with your agent to get that offer in. And so I think these tech tools that agents are using are going to be here to stay, to really elevate that look of the home and make sure that people really can preview and use their time wisely. I think as far as consumer behavior goes, there are some changes too that are here to stay. That move to multi-generational homes with aging parents. As far as we understand right now, that's a sticky trend. We're seeing that nursing homes are actually suffering financially. And so I think that could be something that we may see, is that people embrace and want their family members there. Why this matters. You guys have a big influx of millennials into your market. You guys have had the influx of millennials who are there as the buyers, who are moving from other states, who want to be in Denver, be close to hiking, love the legalized marijuana, whatever the reason is to move to Denver, they are there. Job market, weather, so on. Why this matters is that those aging grandparents are going to move to those areas too. They are going to follow their millennials who once will finally have kids, or maybe they won't. They want to be close to friends and family. Friends and family matter a lot right now coming out of the pandemic. That is a trend to watch, and I think it's a sticky one. So that's something really, you may have a lot of aging seniors who are suddenly moving to Denver and are now retired.
Well, and and to your point of the virtual, I think it's in everybody's best interest to spend a little bit more money on your marketing so that you include like 3D Matterport type marketing, because a lot of people have learned. I mean, look at us today. We've got 120 people on this call. If we'd have had this panel discussion at the DMAR offices in DTC, we might have had 50 people show up. But people are taking advantage of everything they can virtually like this, and I think that's a really good point. And it's always hard to say that something good came out of a pandemic, but I think we have seen some good things come out of the pandemic as far as the way we do things on a day-to-day basis. So. So Tom, give me your opinion. What do you see that you think is going to stick, as it relates to the appraisal process, or however whatever else you look at?
So the modernization of the appraisal industry has been something that's, needed, help for a long time. And I think that we're really starting to see some common sense, practical parts of that. The pandemic obviously has pushed many things forward, right? As they should have, but it's pushed it forward even faster. You mentioned the Matterport technology. Pretty soon, an appraiser going out to the home to measure and photograph is going to go away, with the exception of some super jumbo, multi-unit properties, non-conforming, properties that don't fit the neighborhood, that aren't common. Those might be the exception, but that's really where we're going with this, because Fannie and Freddie want appraisers to be at their desks, analyzing data and determining the most probable price, right? And opinion of value. Data sets are something that are coming online now. So I mentioned that UCDP portal that I posted out there. By the way, appraisers do not have access to that. It's a tool that they use once we submit our appraisal. But where it's going is we will be provided data sets. One may be from Fannie and Freddie, one may be from another artificial intelligence, big data, algorithm, whatever. And we will reconcile our human brain appraisal, right, that we put on paper with those other two data sets, reconciling in between them as to what we came up with. And we will be reporting that, hey, that big data set, that particular algorithm appears to have gotten tricked in this condominium building. It couldn't figure out that the view from one side of the building to the other is a 30% difference in the price. So those are the kinds of things that we'll really see as we move towards the future. Education is the key to it. Education is everything. I speak a lot in front of realtors. I have learned so much in my career, and I take that knowledge back to my team of 200 or so appraisers. I learned something. I've taken a lot of notes from all of you guys today, Scott and Jessica. Tremendous. So I've got a lot of stuff that I can't wait to talk to my team about that I just learned from all of you. But we're really seeing a change, and the biggest thing is with realtors, you guys have a broker where you hang your license, and that managing broker is going to have a weekly meeting or a meeting every however often, and you're going to be learning new things, and you're going to be around other people and collaborating and working together. And the appraisal business is a cottage industry, and many of them work solo by themselves, alone. And we're humans. And one thing we've definitely learned in the last 15, 16 months is that we need to be around one another to be better, right? We really need that. It's very, very important to bounce ideas off each other and work together and collaborate to make each other better. And the industry, being a cottage type industry, we don't have that. And that, the education side of it is something that we work really hard at, but we're just one company. And I think the industry, so, as realtors and an organization, National Association of Realtors, Colorado Association of Realtors, anytime you guys have an opportunity to get out in front, because you guys have a much stronger lobby, you're much more powerful. Remember, there's only 90,000 appraisers in the entire country. Of those 90,000, there's on the residential side, there's probably about 40 to 45,000 practicing appraisers. That's a very small number. So, work with that to try to help, elevate. We're doing our part, but we can work together and really, I think, change the industry for the better.
Thanks, Tom. And one of the things you said that was really interesting to me is I'm trying to visualize how an appraiser will be able to assess the value of a property without physically measuring and physically really, because until we can create something that, like a Google, maybe it's already there, Google Maps, where you can actually measure the house from Google Maps or something like that. Also smell-o-vision, you know what I mean? When there's things sometimes when you walk into a house, I mean, that's the hard part, with somebody, if you're doing a virtual tour with somebody, everything looks great, but when you walk in, you fall over from the odor.
It's a great point. I say that a lot.
What do you think? How do you think, what do you see happening technology wise that's going to allow you guys to continue to do what you do? Or will the standard change?
Yeah, well, look at what's happening, right? The time frame of contract to closing over the last short period of time. Look at how much that has shrunk. So the due diligence is being done more on the front end than in the contract period. Pre-listing home inspections, right? Now you're doing virtual home tours. The virtual home tour, they're measuring the house. Nobody wants to touch square footage because of liability, right? Nobody wants to say it's 3,500 square feet. Appraisers are okay with that because we're very good at measuring and we're comfortable with it. But again, if you think about it, if they're doing a VHT and they've got the square footage in AutoCAD and the assessor data, I mean, let's not talk about Cook County, Chicago assessor data, forget it. And any of the older areas, right? Assessor data can be bad, but if you get in areas like Vegas or Arizona, I mean, the data is perfect. It's, everything built after 1980. It's very clean. But, I think we'll see a lot of those question marks get answered. You just won't have enough time. And, we're seeing it a lot of times here too, where they're doing a lot more due diligence up front. We bifurcate the process at Value Centric. We separate out field appraisers and back-end data and analytics. We work in teams. So our field appraisers only stay in the field. And our data and analytics team that are experts in those markets with competency write the reports. They're in constant collaboration, talking to one another. We find it to be a very efficient way to produce a high quality document and an extra set of eyes, right? And a great way to teach and train and mentor the next generation of appraisers working on those teams, both in the field and in the office with the data and analytics. So, it'll take time. It's not perfect, but I think that you'll see a lot more. There's really no reason why, when you think about it. If they're doing a virtual home tour, they're doing all the measurements, they're doing all the photographing, maybe it goes an extra step further with the, like you said, I've never heard the smell-o-vision. That's great. But I say that a lot. One thing you can't get off a listing sheet is how does the house smell, right?
Yeah, that's so true.
Yeah,
so
I
true.
say that a lot. So that was great. I'm going to steal that from you.
Anytime. No charge for that one. All right, Scott, what about you? What do you see in post-pandemic that you think is going to stick? Anything more there that you have to offer?
Well, yeah, I mean, I think clearly, this format in some measure meaning is going to stick, and I think it's incredibly efficient. We've been able to, in the administration of professional standards statewide at CAR, been able to draw from a much broader geographic pool of hearing panelists and from around the state. And there were some really good things in that regard. But in terms of the business, I think all three of you guys had alluded a little bit ago to, buyers buyers agents and listing agents both using technology that is available more efficiently. And I think particularly in this kind of market for buyers agents to figure out ways to use technology and access to properties virtually and otherwise more efficiently is super, super important for them or for you guys, because if you're not efficient, you can have buyers that are going to run you around. You're going to write dozens and dozens of offers, never get anything accepted, and end up in a buyer that decides they're just going to continue leasing, or they're going to just take their own house off the market and stay there, or whatever it is. And so one of the things
Welcome to our world.
Well, I know, and I feel terrible. I mean, I obviously feel terrible for buyers in this market. I feel terrible for buyers agents in this market. And so I used to say, Colorado's been a hot market for a number of years. And I've said repeatedly that, this is not a market for every buyer. Over the last, 6-8 months, I say this is not a market for any buyer. And I honestly believe that, to some degree, that's actually the case. So from an efficiency, so using technology in terms of post-pandemic that continues to evolve and be really, really fantastic, minus the smell-o-vision piece, is going to be important for you buyers agents to make sure you're using your time wisely and not spending your gasoline and your weekends necessarily, in some cases, physically running people around. And then a derivative of that I love giving non-risk management advice to brokers because they get tired of listening to me just try and scare them all the time. But since from baby real estate school, the first thing you learn is qualify your buyer. And what that's always meant is qualify them financially. In this market, you have to qualify your buyers emotionally, right? They think they're ready for what they're getting into in this market, but they're not. And I think you guys know that. And that's going to be tough on them as they continue to write offers that are rejected and write offers that are rejected. But it's also going to be tough on you. And again, what I'm seeing happen with that is after 3 months or 6 months of not intentionally, but essentially wasting your time as a buyer's agent, they decide, hey, I'm out. I'm going to give up. I'm going to try it, and we're going to move to Boise, Idaho, or move someplace else, or we're going to just renew our lease for another year, whatever that might be. And in that case, you guys are out all of that. I mean, there's just no recompense for you all. And so being good about qualifying your buyers, obviously financially, but also, like I say, emotionally, I think is important. And utilizing that technology that has become increasingly available to make you more efficient so that you're not, if you don't end up with a closing, so far out of pocket and time and everything else.
Yeah. Thanks, Scott. Guys, I'm looking at the chat and I see that we have a couple of questions in there. One of them had to do with the pre-listing inspection. Not sure I understand, if a seller doesn't know or disclose about items, why have the seller find things with a pre-sale inspection? That's a good question. I think, from my perspective, what I tell my sellers is, we don't want any surprises. Like I said earlier, I don't know everything about my house, and I've lived in my house for a long time. But if I had a real inspector come through here, I'm sure they'd find stuff. So I tell my sellers, rather than have surprises and wait for the buyer to do their inspection, why don't we do a pre-listing inspection so you know what you're dealing with, and also you can make the decision on whether or not you would like to make any repairs or take care of some of those items before we even put it on the market. Would probably be good. But then the second part of that, is I think you make a buyer feel a lot more comfortable when you can say in the listing, we've already done a pre-listing inspection and we're going to provide you with all that information. So I think it helps you, helps your seller get better offers and get more confident buyers under contract. And that's just my take on it. Everybody's got a different way of doing things, but I like that idea, and it seems to work really well with my sellers.
Mike,
the point that I think of the question is, and the fact of the matter is, under state law, under our real estate contracts, contractually and statutorily for brokers under license law, the disclosure obligation is specifically based in both cases on actual knowledge. And so in doing a pre-listing inspection, you are clearly gaining actual knowledge, both you as a listing agent and as a seller, that would require disclosure. The way I would say that it might be valuable to do a pre-listing inspection is in the event that your seller had an anticipation that that the buyer was going to be waiving their own inspection, in which case that might be something that would help exculpate a seller for a post-closing lawsuit. But I know they're common in some other markets across the country. I'm not sure I'm a huge fan of them, because whatever information is garnered out of those does become actual knowledge for both the listing agent as well as the seller.
Yeah, absolutely. And when we do that, we provide the buyer with the inspection report. So whatever we found out, they know too. So it is disclosed. It's separate from the property disclosure, but it's a separate report that we send it to them. So that's a good point. Another question: if the buyer can't get approved for the loan, why would they not get their earnest money back? In this particular case, and Scott, again, you can pipe in on this one too. In this particular case, what we're discussing is the fact that the buyer didn't act in good faith, as is required in the contract, to execute the contract and to perform. And that's the difference then in this case from maybe other cases when you can't get your loan. Scott, do you have anything to add to that?
Yeah, no, I wasn't familiar. I mean, I heard your scenario, so I'm not necessarily familiar with the details, but it does sound like the lender sort of softly implied maybe that it had less to do with the buyer's financial qualifications for not getting the loan and more to do with the lack of cooperation in making loan application for the buyer, in which case the indication could be that the buyer is not acting in good faith under the contract, which would make the earnest money non-refundable on that basis.
Yeah, and time will tell, right? This just happened yesterday. So, Jess, you were going to say something, I think, on the inspection.
Yeah, that is something that we saw increased pretty dramatically during the pandemic as well, just reducing the number of people in a home and really with backlogs of truly everything in real estate services. That was something. Something that I think is important to note too there is, regardless, Scott will tell you whether it's a good idea or not a good idea legally, homes are old in the US. And we know that they're getting increasingly older, and people have stayed in homes now for a record tenure of 10 years before selling. And that's a median. So half are staying in that home longer. Some were still underwater from the Great Recession and they're still working their way out of it. But people also locked in really low interest rates. So they just stayed put. And with that lack of movement means that there's a lot of work that needs to be done with homes. And that's already been talked about, but the buyer expectation is that everything's going to look beautiful. But once you get down to the systems in the home, people often overlook those because they see the quartz countertop and they don't care about the roof, or they don't care about the hot water heater that's ready to explode. So I think it is, an important thing to do if you can swing it and still make that contract to go. Okay.
Yeah, good point. And Jess, also, if you guys on the call, if you want to go to the chat and you go to, Jess also gave us some information on realtor incomes, pretty interesting, and a website where you can find it. The other thing I want to make sure we mention here is that this particular Connect meeting is powered by the West District, of which I am a part, and a lot of our industry partners, not only from the West District, from other districts, have put their names and phone numbers and contact information in the chat. And so I would encourage you all to please take a look at who's there and let's support our industry partners. These are the people that certainly support us through our transactions. And when you're doing these Zoom meetings, they don't get the same opportunity to network and connect with you as realtors. So please be sure to check that out, and thank you to the West District for doing this this event. So does anybody have any other questions? If you do, please put them in the chat and we can answer them for you. And in the meantime, I also want to thank the staff, Julie and Hannah. They just do a great job with this stuff. Even Nobu helps out once in a while, but we've got a great staff at DMAR, and we love them, and they are great, and they do a great job for us. These events take a lot of work and a lot of planning, and to the degree that we have the quality of people that we do have at DMAR staff, we're very fortunate, and we really appreciate them. And Tom, it looks like Nobu put in the chat that it's already here. The technology's already here. And it's been launched, tech that does what he mentions.
I appreciate you mentioning one of my competitors, Nobu. Thank you.
Oh wow, Nobu! Did you see what you did there?
I'm just teasing. No, no. Clear Capital wrote the algorithm for Freddie Mac's UCDP portal. So they're a big company, and I know John Brennan, who's their chief appraiser. John was tremendous in working, with the industry. He spent a lot of time, doing. They're very forward thinking. There's a lot of good things coming with which is this Perea that's out there for teaching appraisers, mentorship. So I'm very long on the industry. I really feel that all of you on this call that have maybe been frustrated will see some dramatic improvements in our industry. over the next 5 years that I think will be very beneficial for everyone.
That should be interesting to see for sure. And it looks like Nobu also posted, if you go to the chat, he posted a website, the NAR buyer seller profile he said it's a great download. So check that one out. You know, I'd like to thank all of our panelists. You guys were great today. I think you provided us with a ton of information, and this has been recorded. So people like me that were too busy being involved and not taking notes, I'm going to go back and watch this so I can get, you know, write down some of the things that you guys are talking about, because it was very thankful. So Scott, Jess, and Tom, thank you so much for everything that you did for us today. Do you have any parting words that you'd like to share?
Hey, Mike, there's been a couple of requests that people want to hear Scott's story. Scott, you said if we had time, you had a story.
All right, I'll tell you the story.
Go, Scott.
Perfect. Well, so this is a super cautionary tale on appraisal gap clauses as it relates to the listing broker, right? And so at the very beginning, when the market started blowing up and we started seeing a lot more of these appraisal gap clauses being written, it was important, and a lot of buyer's agents even were confused by the fact that these clauses generally are just one way. It obligates a buyer to bring additional money to meet the appraisal gap. It doesn't obligate the seller to accept that additional money to the extent that it's even 1 penny below the purchase price that they've agreed to, unless it doesn't. And here's the flip side of that. So this was a resort property, a little 2-bedroom condo in more of a mid-tier resort community here in Colorado. Just a few weeks ago, and the listing broker is crying literally to me, and I felt terrible for her. But the appraisal gap clause that came in, the purchase price was $510,000 on the property. The appraisal gap coverage was $15,000 that the buyer had agreed to bring over and above the appraised value. And the appraisal came in at $410,000. So we've got a $425,000 obligation on the buyer. Now, a normal appraisal gap clause would essentially say that, you know, probably contract's dead unless somehow the buyer wants to bring the additional money, the additional $85,000 essentially, in order to meet the full purchase price. But in this case, that appraisal gap clause had 5 additional words in it that I think swung the whole thing. And that was buyer agrees to bring and seller agrees to accept up to an additional $15,000. So those words, and seller agrees to accept, 5 words, I think probably, and this is so new that it hasn't litigated, and I'm not even sure where it ended up, but the reality of it is, I think that made it a mutual or bilateral appraisal gap clause, which means that the seller now was reducing the purchase price to the $425,000 all the way down from the $510,000 that they were under contract for. So that broker, listing broker, incredibly upset. They had like 26 offers on this property, and she was just overwhelmed in processing it, focused on you know, the purchase price and closing timeframes and all of those other details, and missed those 5 words in the clause. Now her seller is likely going to be suing her or tapping into her errors and omissions policy, and she's probably not taking a fee for that closing as well. So the cautionary tale to listing brokers is you got to pay attention to those details. Those just 5 words can swing things pretty dramatically for a seller in that case, and you can promise the seller's blaming the listing broker for that. So that's my story to ruin your weekend.
Man, that is scary. That is really scary, boy, and so true. You know, Phil Shell's my managing broker, and he is always telling us just slow down. You know, slow down. Pay attention to the details, because when something falls through the cracks, it may seem like it's no big deal at the time, but it can sure come back and bite you later. No doubt about it. All righty. Thank you all again. A few announcements, if we could, please. The YPN New Development Insiders, Tuesday the 22nd. This is really going to be a cool event if you can make it. It's going to be 9 a.m. to 1 p.m. at the Mile High Station. We're going to have 12 developers, builders who will be represented, from a custom home development in Franktown to a master development with 5 builders out by the airport, to luxury condos in Denver. Also, you're going to hear from John Covert, Senior Director of ZoneDot Colorado Region, as he talks about overview of new home market trends, top projects in the area and why, innovative home designs, opportunities and challenges facing the home building industry into 2022. So tickets are for in-person and virtual attendance can be bought online. So if you can make that one, please do. That's going to be good. I'm going to be there for that one myself. The Rpac Fundraiser, we have, those of you that are in our industry, realtors, I know how challenging it can be at times, you know, especially if you're just starting out and so on and so forth. But this association, the NAR, your local association and the state association count on us to help fund what we need to fund in order to protect us and protect home ownership in our markets. So out of every closing, if you can donate $25 to Rpac, please do that. If you can donate more, please do that. It's very important. We have seen so many ways that Scott and the local association people, Peter at DMAR, have been able to affect change legislatively to keep us in business and to protect home ownership. So I really hope that you consider that. And also, we're doing a fundraiser, Rpac is, on September 23rd at Topgolf, and you'll be seeing more details coming on that. Scott, I don't play golf either, but I'm definitely going to go to the fundraiser, and you know, I might have a cold beverage or something while I'm there. So also look for this one. We're excited to have this come back into play. WIRED, Women in Real Estate Denver, is the acronym, is WIRED, and it's coming to the Cable Center at DU on October 13th. We did our first one 2 years ago. Heather Heyer, who was our, she was the chair of the board of directors at the time. She helped put that together, and she emceed that one, and it was a great event. And I understand that men are even welcome to come to this women's event. So that's good news, guys. You can show up and learn something about women in real estate Denver. Our next DMAR-wide Connect meeting is going to be Friday, July 16th at 9:30. And this one's going to be powered by the Central District. Building your tribe and how that can help your business in this bidding war market. I would assume that means building your team of lenders, title people, inspectors, etc. We don't have any properties to market today on this Connect meeting. So unless anybody has anything else they'd like to add, again, I'd like to thank our speakers, Scott Peterson, Tom Schur, and Jessica Lautz, for their time today and for their insight. And we really appreciate all of you guys joining us. So with that, we're going to bid you all adieu.
Have a great
Thanks,
weekend,
everybody.
everyone.
Thank you.